Welcome back, everyone, to our continuing series on financial management. Myself, Gokul. I'm working as an assistant professor in the Department of Master of Business Administration, visiting with the Common Institute of Technology. In this session, we will be diving into part three of the Unit 1, Foundation of Financial Management. We have already covered the three basic financial decisions and the role of the finance manager in part 2. Now, in part 3, we will build on that by exploring key foundational concepts, starting with the definition of finance, moving into the objectives of finance, functions, and then diving into one of the most important principles in finance, the time value of money. This concept is essential not only for finance professionals, but for anyone making long-term financial decisions. This session is structured to deepen your understanding of what finance truly means and how time affects money. We will start by looking at classic definition of finance, then break down the course objective of finance function, and finally explore why a rupee today is worth more than a rupee tomorrow. These ideas form the bedrock of financial analysis and decision making. Let's begin by understanding what finance really means. Different scholars have defined it in ways that highlighted its managerial and strategic nature. According to Paul G. Hasing, finance is the management of the monetary affairs of a company. It includes determining what has to be paid for and when, raising the money on the best terms available, and devoting the available funds to the best uses. This definition emphasizes three key actions: planning, payments, timing and prioritization, raising funds, sourcing money optimally, then last allocating funds, investing wisely. Then next definition, according to Kenneth Midgley and Ronald Burns, states finance is the process of organizing the flow of so that a business can carry out its objective in the most effective way to meet its obligation as they call due. Here, the focus is on efficiency, objective alignment, and liquidity management. Together, these definitions show that finance is not just about money, it's about managing money to achieve goals efficiently. Based on this definition, we can group finance function into six key areas. First one, financial planning. Second, financial control, financing decision, investment decision, management of income and dividend decision, and last area, incidental function. Let's see about the financial planning. Financial planning is the forecasting needs and ensuring resources are available. Then financial control, it monitors performance against plans and budgets. Then financing decision, choosing sources and mixes of funds. Then investment decision, allocating funds to assets and projects. Management of income and dividend decision, it decides how to distribute profits. And then finally, incidental function. Other related tasks like insurance, tax planning, and investor relations will be dealt in this finance function. These functions are interconnected and ensure that finance supports both operational efficiency and strategic growth. Then we can move on to the finance function objectives. What is the ultimate aim of the performing this finance function? Let's look at four core objectives. assessing the financial requirements. It means it's accurately estimating how much money is needed for what purpose and when. This prevents both shortage and idle funds. Then proper utilization of funds, ensuring that every rupee is used effectively, whether in project, operation, or investment to generate return. And third, increasing profitability. Through efficient fund management, cost control, and strategic investment, finance aims to boost profits. Then final objective is maximizing value of firm. This is the overarching goal. All financial decisions should ultimately increase the market value of the firm and wealth of shareholders. These objectives guide every action a finance manager takes. Now, let's move on to one of the most critical concepts in finance, time value of money. Time value of money is based on the simple truth money available today is worth more than the same amount in the future. Why? Because money today can be invested to earn interest or returns. This principle is the backbone of discounted cash flow analysis, which is used to evaluate investment projects and financial instruments. Two core of time value money techniques are compounding and discounting. Calculating the future value of money investing today is called compounding. Discounting means calculating the present value of money to be received in the future. Simple words we can say as 1 rupee today not equal to 1 rupee a year from now, because that rupee today can earn interest. That's the concept of the time value. This isn't just a theory, it's a practical reality that affects loans, investments, savings, and business valuation. Let's explore the why time affects money value. There are four key reasons: risk and uncertainty. The future is unpredictable. Cash flow expected tomorrow may not materialize due to economic, market, or operational risk. Inflation in an economy, the purchasing power of money decreases over time. A rupee today buys more than a rupee will be in the future. In third, consumption preference. People generally prefer to consume now rather than later. Immediate gratification has psychological and practical value. Then, fourth, investment opportunities. Money received today can be invested to generate returns. Delayed money means lost earning potential. These factors make timing a crucial element in financial decision making. Then we can move on to the interest rate. Interest rate are the price of money over time. They quantify the time value of money. Whether you are saving, borrowing, or investing, interest rate determine how much future money is worth today and vice versa. These are the various types of interest rates. You can see that simple interest, compound interest, and effective interest. Simple interest in the case means interest paid on only the original amount or principal borrowed. Compound interest means interest paid on any previous interest earned as well as on the principal borrowed. Effective interest means interest earned after adjusting for number of compounding periods per year. Then we can move on to the valuation concept. Time value of money is directly applied in valuation, whether valuing a business, a bond, a stock, or a project. By discounting future cash flows to their present value, we can determine what an asset is truly worth today. Next, we can see the types of annuity. Before seeing the types of annuity, I will explain what is annuity. An annuity is a series of equal payments or receipts made at regular intervals. Annuities are common in loans, leases, pensions, and investments. There are two main types. One is ordinary annuity, and second one is annuity deductible. Ordinary annuity means payments are made at the end of each period. For example, bond coupon payments, EMIs, etc. Annuity due means payments are made at the beginning of each period. Example, rent, insurance premium, etc. The timing of payment affects their present and future values, which is why distinguishing between the two is essential in financial celebration. That concludes part 3 of Foundation of Financial Management. We have covered definition, objectives, and vital concept of time value of money, a principle that will reappear throughout your finance journey. If this was helpful, please like, share, and subscribe for more structured lesson. Drop your questions in the comment section below. I am here to help you all. Thank you for the learning with me. See you in the next class. Thank you.